Hi, everybody. Welcome. We're just going to wait for a couple, just a minute or so while people log on. Okay. All right. Happy Friday, everybody. Welcome to Majority Action's 2024 Proxy Season Debrief. My name is Divya Sundar. I am the Research Director here at Majority Action, and I'll be moderating today's webinar. Okay, so here's our agenda for today. I'm going to start with just some housekeeping items. This webinar is being recorded. The chat has been disabled, but we will have time for discussion and for Q&A. And so we invite folks to use the Q&A box to put your questions to put your questions in. And we will send you a copy of this presentation after the webinar. I'm going to be moving through these slides pretty quickly in the interest of time. So you'll have an opportunity to spend more time with them after the webinar. So onto our agenda. Oh, I do see a hand raised. Okay. So if you have questions, please put them in the chat. I do see that folks have their hand, one or two people have their hands raised, and we will answer them. Okay, so moving on to our agenda for today. I'm going to start by providing a brief recap of key trends and votes during the 2024 proxy season. After that, we're going to hear from three really fantastic panelists. Bianca Agustin, Co-Executive Director at United for Respect Education Fund. Kerschke, Deputy Director of Corporate Governance and Sustainable Investment at the Illinois State Treasurer. And Ibrahim Rashid, Research Analyst, Sustainable Investing at Marquette Associates. So we're going to have each of our speakers give some remarks, and then we'll have some time for group discussion, Q&A, and then we'll close out. Okay, so I'm going to start by providing some context. Majority Action, as you all know, focuses on two key issue areas, climate change and racial justice. And in both these areas, the crisis has continued to become more acute over the years. We are once again seeing record-breaking temperatures that I'm sure many of you experienced recently, or are experiencing now. The racial wealth gap has only widened since 2019 as communities of color bear the brunt of rising prices, tightening labor markets, and corporate malfeasance. And yet, the largest asset managers have largely abdicated responsibility in this realm. On the climate side, 2024 saw a number of US asset managers leaving CA 100+. On the racial justice side, we learned this month that BlackRock is pouring money into a Texas anti-woke stock exchange that is designed in part to rebuke the board diversity requirements instituted by the NASDAQ. So there is a lot more to be said here. We could have an entire webinar about that, but I think this juxtaposition between the escalating crisis and the increased retrenchment we're seeing by asset managers is important for us to bear in mind as we review this season's trends and think about what we're going to do going forward. Okay, so what did we see on the climate side? There have been a number of great analyses already on climate shareholder proposals, so we're not going to discuss that here. Majority Action's focus on climate is on director accountability at companies with poor climate performance. Every year, we identify climate critical companies that are most misaligned with a net zero pathway. This year, we focused on 4 industries: oil and gas, utilities, banks, and insurance companies. And so this slide shows you the universe of companies that we looked at this year. We then assess those companies' climate performance using various benchmarks and then recommend against directors who we see as most responsible for oversight of those issues. So for the sake of time, I'm going to focus today on just the oil and gas and electric utilities industries. This slide here shows you the metrics that we use this year to assess the oil and gas and utilities companies in our universe and the no vote recommendations that we issued. Okay, so what did we find? In general, we found that directors targeted for a no vote underperformed compared to their peers. So this chart looks at targeted directors at oil and gas companies and shows where they ranked in terms of level of support relative to directors at other peer energy companies. So you can see from the slide that 7 out of the 11 directors that we targeted rank in the bottom third in terms of support. We see something very similar in the utility sector, where 10 out of 14 targeted directors ranked in the bottom third. So that's encouraging, right? However, as you can see from this chart, these same directors did receive on average more support in 2024 than they did in previous years. So this is a reversal of the 4-year trend of declining support. And this is consistent with the broader retrenchment we saw from the largest asset managers on climate accountability this year. So that's a little bit sobering, but I want to focus next on a bright spot, and that's the extraordinary investor action we saw at ExxonMobil this year. As you all likely know, Exxon pursued an unprecedented lawsuit this year against 2 shareholders who filed a climate-related proposal. That lawsuit has since been dismissed by the judge, and we will wait to see what happens there. But during the proxy season, Exxon also attacked other shareholders who have pressed the company on its mismanagement of long-term risks, including climate risk. And we saw incredible investor activation in response to these attacks. The Illinois State Treasurer filed an exempt solicitation calling on votes against Chairman Darren Woods and Governance Committee Chair Joseph Hooley. CalPERS filed an exempt solicitation calling on votes against the entire board. A number of large institutional investors pre-declared votes, and 13 public and private pension fund trustees called on asset managers to vote against Woods and Hooley. So ultimately, Woods got 91.6% of the vote, Hooley got 87.1%. And while those numbers may seem high, only 7% of S&P 500 energy directors got less support than Woods, and only 2% got less support than Hooley, which is remarkable. So what are the main takeaways here? Well, first, we saw incredible use of the exempt solicitation and pre-declarations as tools of investor power. And as we go into next season, this is momentum that we want to continue to build. Second, we continue to see asset manager misalignment. Initial results suggest that despite the wellspring of investor action, the largest asset managers who hold, close to 30% of Exxon still voted for Woods and Hooley. So this question of how to address misalignment is one that we'll get into with our panelists very shortly. Moving on to racial equity. We're first going to look at racial and ethnic board diversity. So this year, Majority Action recommended that investors vote against the nominating committee chair at Russell 1000 companies with all white boards. And we track racial and ethnic board diversity not because we think it's one of the most pressing racial justice issues, but because it is one place where the largest asset managers have clearly articulated minimum expectations for issuers. So for example, Fidelity's 2024 proxy voting policy explicitly states that it may vote against directors if the board lacks racial or ethnic diversity. For years, asset managers have focused their board diversity efforts on the S&P 500, but some of them have recently widened their scope to include the Russell 3000, which is why this year we looked at the Russell 1000. So in 2024, there were 8 companies in the Russell 1000 that had all white boards. And this chart here compares director support for the nominating committee chair to other directors at the same company and to Russell 1000 directors more broadly. The major takeaway from this chart is that the nominating committee chairs at these companies underperformed relative to their peers significantly, suggesting that investors were willing to use director votes to hold companies accountable for lack of racial or ethnic board diversity. Next, we're going to look at workers' rights proposals. So this is another bright spot. This chart on the right looks at support for various types of workers' rights proposals. And we see here that investors continue to demonstrate support for proposals on pay equity, workplace safety, DEI, and freedom of association, and that these 4 types of proposals outperformed ESG proposals as a whole. So this suggests that investors are continuing to assess and take seriously human capital management risks. Okay, finally, we're going to look at racial equity audit or REA proposals. And for more on what an REA proposal is, what REAs are, I encourage you to go to the Majority Action website where we have a handout that clearly explains what a good racial equity audit is. So the news here is a little more sobering. These two graphs illustrate that there were fewer racial equity audit proposals voted on in 2024 than in previous years, and that these proposals received less support than in previous years. And again, I'm going to move through these slides quickly, but we will send you a PDF of them after the webinar. This slide looks at the performance of the 5 REA proposals that were voted on this year. So again, only 5 proposals were put to a vote this year compared to, I think last year there were 18 proposals filed, and the year before that, 15 proposals. The 2 refiled proposals received less support in 2024 than in 2023. And the Geo Group case is particularly striking. So in 2023, that proposal received 44% of independent votes. In 2024, the same proposal received less than 8% votes. The graph on the right shows that proposals filed at Walmart and at Wendy's got less support than proposals filed at peer companies in previous years. So I want to direct your attention to the middle set of bars that shows the level of support for Wendy's relative to the support for the REA proposals at McDonald's and at Chipotle. These are all low-wage fast food employers, but marked difference in terms of performance. Okay, so while all of that is sobering, I do want to conclude by focusing on a bright spot, and that's the Walmart REA. So this was a refiled proposal, and while there was some backsliding, it still did very well, garnering nearly 35% of independent votes. And focusing on independent votes is really important here because the Walton family and insiders own nearly 50% of Walmart. So one aspect of this campaign I want to highlight is the visibility of frontline Walmart workers. This was a proposal filed by a worker organization, United for Respect, and we're going to hear more from Bianca in a minute. Workers were intimately involved in this campaign in a variety of ways. They spoke in front of investors, their concerns were profiled in the press, and they even spearheaded a sign-on letter to the Walmart board. And one of the most important things the workers brought to the investor conversation was a credible counter-narrative on management's a credible counter perspective on management's narrative. So what do I mean by that? Well, for example, Walmart in its investor materials pointed to all its DEI initiatives as a reason for why it didn't need to conduct an REA. Workers, however, were able to verify that most of them had never actually heard or experienced any of these DEI initiatives. That's like really valuable information for investors to have. So what's the takeaway here? Well, I want to suggest that when investors are considering where to file an REA proposal, or any proposal really, they should look for and actively partner with stakeholders, workers, labor unions, environmental justice groups. These are stakeholders that make active demands on the company, and they're constituencies that can increase the salience of the risks in question and offer a credible alternative to management's narrative. And management's narrative really tends to dominate investor spaces. So bringing those constituencies into the conversation is really important. We think this kind of partnership going forward is going to lead to more successful voting outcomes. So that concludes our 2024 proxy season review. We will be publishing a much more detailed analysis of the season in the coming weeks. So keep an eye out for that in your inboxes. All right, you've heard a lot from me. I'm going to stop talking. And I'm really excited to turn it over to our speakers who are going to talk about some of the actions they took this proxy season. First, we're going to hear from Bianca Agustin, Co-Executive Director at the United for Respect Education Fund. Bianca?
Thanks, Divya, and good morning to everyone joining today's call. My name is Bianca Agustin, and I'm the Co-Executive Director of United for Respect Education Fund. For those of you who are unfamiliar with our work, we are a national nonprofit focused on raising standards in the retail industry and developing the leadership of frontline retail workers to exercise their legal and human rights to safe working conditions, living wages, and equity in pay, promotion, and treatment. United for Respect sees investors as critical stakeholders and necessary partners in efforts to mitigate harmful industry practices and hold companies accountable to high standards of conduct and operation. We have long engaged and partnered with Walmart investors, some of whom are on today's call, to address issues important to the well-being of Walmart associates, including paid sick and family leave, sexual harassment, and gender and racial pay gaps. This year, we refiled a proposal calling on Walmart to conduct an independent third-party racial equity audit to help assess the direct and indirect impact of company policies and practices on its diverse workforce and the communities in which the company operates. By Walmart's own disclosures, we know inequities within the company persist. People of color make up half of Walmart's hourly workforce, but less than 30% of company executives. Walmart is also at the center of numerous controversies concerning racial discrimination and incidents of workplace violence, including racially motivated attacks against associates, happen at an alarming rate in and near Walmart stores. As the largest corporation in the world and the biggest private employer of Black workers in the United States, Walmart's policies and practices have far-reaching racial equity impacts. The bottom line is that making positive change at Walmart will have ripple effects across the industry and our economy. This year, the racial equity audit proposal, as Divya said, received nearly 35% support among non-insider shareholders. A proposal filed by Cynthia Murray, a 24-year Walmart associate and UFR member leader, calling on Walmart to implement measures to promote workplace safety and prevent workplace violence, received over 43% support among non-insiders. This was the highest vote share of all resolutions filed this year at Walmart. And Oxfam's proposal, calling for a human rights impact assessment, secured close to 30% of the non-insider vote. These top three proposals at Walmart were resolutions that advanced racial equity, health and safety, and human rights. A clear indication to me that Walmart investors tried to hold the line during a time of increasing retrenchment on ESG issues. While the support did decrease slightly from last year, I am heartened by the fact that investors demonstrated significant support for resolutions focused on human capital management issues at Walmart in 2024. As many of you know, shareholder season isn't the only time investors and advocates can engage with companies, and at UFR, we believe that an ongoing dialogue between workers and company stakeholders should happen all year long. And so we are continuing our work with Walmart associates and other stakeholders to continue to move the needle on issues critical to worker well-being. And we look forward to partnering with Majority Action and others of you on this call in the coming months and years. Thank you to everyone and to Majority Action for inviting me.
Thank you, Bianca. And I just want to remind folks that we do have time for Q&A at the end. So if you have questions, please put them in the Q&A box. Next, I want to pass it to Karen Kerschke, Deputy Director of Corporate Governance and Sustainable Investment at the Illinois State Treasurer.
Thank you. And just thank you for having me here today to discuss the 2024 proxy season. Like you said, my name is Karen Kerschke, and I'm a Deputy Director for Corporate Governance and Sustainable Investment at the Illinois Treasurer's Office. I just want to thank Majority Action for your important work on climate risks and racial equity. And just like Majority Action, we at the Treasurer's Office believe that asset owners, like ourselves, should leverage our rights as shareholders to vote our proxies, engage companies, and engage our asset managers on these topics. And that's why this proxy season, for example, we supported all 5 racial equity audit proposals. Before I get started, I want to provide a quick overview of the Illinois Treasurer's Office and our approach to sustainable investment. The Illinois Treasurer manages approximately $55 billion, which includes $30 billion in internally managed state investments and local government investment pools, $20 billion in financial product programs, such as the 529 College Savings Plan, which I think everyone's familiar with. And then we have $5 billion in authorized commitments to private market assets. We integrate sustainability across all of these programs, which is mandated by the Illinois Sustainable Investing Act. And then for our public markets team, which I sit on, we have approximately 10% invested in separately managed accounts. And for these accounts, we vote our own proxies and we engage companies. This proxy season, our office engaged companies on really important topics such as board diversity, health and safety, governance, and climate risks. And there's really a lot I could talk about related to all of these engagements, but for the sake of today's webinar, I will really focus on Exxon. Our office is a member of CA 100+, but prior to this proxy season, Exxon was not on our engagement list. Nonetheless, we decided to file an exempt solicitation outlining that we would vote against the board chair and CEO, Darren Woods, and the lead independent director, Joseph Hooley, for the following reasons. And this really came down to Exxon's decision to sue Follow This and Arjuna Capital, which we saw as an attack on shareholder rights that has a potential chilling effect across the investment industry. And that was really concerning to us. It is our view that investors should have the right to file shareholder proposals. And we also really think that we have the right to determine for ourselves whether something is material or not. And importantly, even unpopular proposals, if legitimately filed, should have the right to go to a vote. And across our office, we see the 14A8 process by the SEC as the right avenue for companies to contest proposals. And I did a little bit of research and found that the SEC actually granted more than 2/3 of no action requests in 2024, which was even higher than 2023. And I think it's kind of a sign that some of the arguments that Exxon was making about the SEC letting too many proposals to go to a vote really didn't hold up. And this goes into our next thought and my next point, which we really view Exxon's arguments for filing the lawsuit as not entirely made in good faith. For one, Exxon cited costs of the shareholder proposal process as one of the arguments for filing the lawsuit. And they really used upper level cost estimates that we don't think are necessarily accurate. And then in this specific case on this shareholder proposal, we also think that the cost to the company would have been minimal, given that similar proposals were filed in the past if they had just decided to go through the SEC process and not file a lawsuit. And then I also want to highlight the fact that in its proxy statement, Exxon really tried to distinguish between their investors, who they said are looking to ensure long-term economic value for their companies, and then other shareholders. And we were really concerned about that because, just to be clear, we are very focused on long-term sustainable value creation for the companies that we're invested in. And we view climate risk as a material risk to Exxon. And we also believe that in the case of a shareholder proposal, shareholders and not Exxon should be the ones determining whether they view the proposal as financially material. That's kind of the reasons why we decided to file this exempt solicitation and call out those two directors and our no votes for them. Then I was asked to provide some reflections on the Vote No campaign. I was happy that Majority Action also did a little bit of an overview at the beginning. I think the Vote No campaign received a lot of attention from investors, from other investors that we at the Treasurer's Office work with and communicate with. But I think it was somewhat moderately successful. I know that they received 87% and 91% of the votes respectively, and Glass Lewis recommended a vote against the lead independent director. But I think we kind of saw a division between asset owners maybe and then the big four asset managers, because I don't think they voted against those directors. And that's something that we definitely noted. I would also be interested in knowing whether the big four asset managers and for their ESG funds voted differently than they did for their regular funds. I want to highlight a little bit and talk a little bit about the asset managers' lack of support that we saw. And some of the reasons that I've heard why that might be. So I think just with the increase in the number of shareholder proposals, investors may be experiencing proposal fatigue. It's also very possible that many of the managers agreed with Exxon's arguments. For example, that some of the proposals were overly prescriptive. And then I think also some of the managers like Vanguard are taking a wait and see approach. I think some of you might have already seen the statement that Vanguard made public about their voting rationale and why they decided to support those two directors. And they kind of made an argument in there that they do question Exxon's reasons to pursue the lawsuit and that they would have concerns if this led to a chilling effect. So I think we will, moving forward, definitely follow up with Vanguard on that and then also see how what the impact of this lawsuit might have been across the investment industry. And then lastly, I know I'm almost out of time, but for lessons learned, we actually filed our exempt solicitation and afterwards sent it to several asset managers that have significant holdings in Exxon just to raise this issue with them. And we did have a meeting with one asset manager to discuss our exempt solicitation. The meeting was very productive. I thought it was very thoughtful from their side. And it's something that we'll likely do in the future when we file exempt solicitations, just to reach out to them, to have more dialogue, to get a chance to explain our rationale for pre-declaring a vote and filing exempt solicitations. And then in our due diligence meetings, we'll likely bring up this vote and also get asset managers' take on the topic of shareholder rights. That's a quick overview of our view on this proxy season and specifically Exxon. I'm happy to answer any questions afterwards. Thank you.
Great. Thank you so much, Karin. Our final speaker today is Ibrahim Rashid, research analyst, works on sustainable investing at Marquette Associates.
Hey everyone, it's so good to be here. I have a little bit of a cold, but I'm hoping that that should maybe clear up. Who knows? Didn't do that for everyone in the last 24 hours. So my name is Ibrahim Rashid. I'm the sustainable investing analyst for Marquette Associates. For those who don't know, Marquette, we're an investment consulting firm based out of Chicago, where we advise a wide range of different institutional investors, pensions, foundations, and so on. 400 billion around assets under advisement. My role is to build the firm's sustainability platform, where I work with our allocators on the client side, helping them think through strategy, whether it relates to place-based investing, community development, net zero, climate, and proxy voting. And then on the research side, I lead manager diligence for all sustainability products across the different asset classes. One of the things that I've been thinking a lot about in the last 2 years since building out this platform that really, I think, came to light in this proxy season is how many of our clients are coming to us because they want to make an impact. You know, all investing has impact in some way, but especially in this market environment, when people think about impact investing, you tend to go in private markets, but this environment has made the private market investing just a little bit challenged. And so proxy voting and selecting managers whose how they're engaging companies, how they're voting aligns with our underlying clients' values, I've realized has become one of the most, I think, effective ways to introduce this impact aligning values conversation with our allocators, especially for us where many of our foundations have small AUM of around 100 million, where they don't go privates. Talking about proxy voting has been a good litmus test. And in the last 2 years, when I look at the kinds of conversations I've had with our allocators, when I look at what prospective allocators are saying in the RFP world, many are asking about questions around racial equity. Many are asking about diversity and climate risk. And so knowing that the racial equity question and the climate question have really become large in the last few years, last year, I spent a lot of time really upgrading Marquette's due diligence policy to incorporate proxy voting and engagement for the first time, where I rewrote our due diligence questions to ask questions to each managers on how are you voting against directors in high impact, climate impact companies like energy, utilities, transportation, and so on. What expectations are you setting for managers to align their companies towards a net zero pathway? If they fail to make progress on their commitments, what are you going to do to hold the directors accountable? And then we added a lot of questions to our due diligence, specifically around diverse director votes, but also racial equity audits. And so last year we checked in with around 50 to 60 managers where we have client assets, met with their heads of stewardship teams to ask them, hey, what do you think about racial equity audits, climate directors, and so on? And, you know, when you're doing these like annual meetings or so on, you always get like a bit of a marketing spin when you meet with the teams. And so one thing that after I did those meetings last year for the first time that we wanted to do this year was during the proxy voting season, while these teams are still coming up with how their voting rationales, we at Marquette decided that we would check in with a handful of our investment managers and use these questions that Majority Action has flagged for us on the votes at Walmart, the votes on Exxon, really as the litmus test with each manager. And so reached out to several of our managers and I asked them in advance, you know, are you going to pre-declare votes against Exxon? What do you think about the state of Illinois' exempt solicitation? How are you thinking about these racial equity audits at Walmart's? And obviously, you know, it's during the proxy season. No one can pre-declare their intention to vote. But we use those meetings to really just signal that many of our clients care about these things. So as advisors, even though we don't vote our shares, we were communicating to managers that these were trends that we were going to track. And so I think going forward, you know, we had several of those meetings, but I think looking forward into this, the next latter half of the year around accountability, My plan is to, for the managers we didn't meet with, for the managers who I did check in with, I want to use the racial equity audits at Walmart. I want to use the climate votes at Exxon really as the litmus test to understand how our managers thinking about these two problems that have emerged as really central issues for our allocators. And so we'll be checking in with several of our managers throughout this year to understand both how did they vote and why did they vote in those ways. And I think just to round out with some reflections on just this season and this process of talking about proxy voting as an advisor, because the role is a little different. You know, we're not allocators like the state of Illinois. I think it's important for advisors to do this asset manager engagement on proxy voting for three things, especially during the season, for three reasons. The first is that it helps us with quality control. Every time as advisors, when we're talking to managers, they're giving us a sales pitch, right? It's always like very nicely crafted and so on. Our job is to try to like look through that. And so when we engage with managers during the season as they're formulating their thoughts, and you're asking them, why are you not supporting racial equity audits when you've wrote in your policy and you've told us last year that you would? It really helps, I think, see like the real intention behind the team in a less markety spin way. So I think doing it during the season as an advisor helps with the quality control. The second is that it helps us align our clients' values to their investments. You know, we have so many clients who their committees care a lot about climate change, racial equity, and they would be horrified, and they have been horrified when we share with them that their managers aren't voting in the way that they think they are. And so making sure that as advisors that we're at least checking is really just, you know, table stakes of upholding our fiduciary duty. And I think the final one, it just makes good business sense. You know, like I said, RFPs are asking us, how can we help our allocators make an impact? It is within good business sense for us as advisors to know how are our investors investing for or not investing for that impact. And so that's what I'll say. It's really important, I think, for advisors to engage on proxy voting, and I'm looking forward to learning with you all on how to do this work better.
Great, thank you all. So there's some really fantastic insights. I'm really excited for us to get into like conversation and discussion. Again, if you have questions for our panelists, please put them in the Q&A box. We have one question here about systemic risk, both systemic climate risk as well as systemic inequality, the risks associated with systemic racial inequality and income inequality. So could you all talk a little bit about how the latest AGM season is making investors reconsider their approach with respect to systemic risk? So for example, saying climate risk is a risk to Exxon or to other companies is true, but that's like an idiosyncratic approach, right? And you could argue that that idiosyncratic risk is less important for long-term diversified investors than systemic climate risk that companies like Exxon are creating for the economy and for entire portfolios. So what needs to happen for investors to incorporate that into their stewardship practices? Can I pass it to you, Karin, first?
Sure. I think at the Illinois Treasurer's Office, we absolutely look at climate change as a risk to our entire portfolio and as a systemic risk. I think we're still in many ways figuring out the best way for a small team like us. We have two stewardship staff, how to engage, you know, companies across our entire portfolio on this issue. And I think this is really where the value of collaborative engagement comes in. So we are a member of CA 100 Plus, and we use that as knowledge sharing, but also we know that we lead engagements at a couple of CA 100 Plus companies, and other members lead other engagements. And that way we can sort of encompass a wider set of companies, right? But I think one step that we have taken at the Illinois Treasurer's Office in the past year or so is to really pay more attention to how our asset managers are viewing climate change and whether they consider the systemic risk of climate change. So we are having conversations with them about how climate change factors into their asset allocation process, how they're evaluating companies, not individually, but also the risk of climate change to their entire portfolio, what their climate scenario analysis looks like. And we have incorporated some of those questions into our due diligence questionnaires, but also we have increased those conversations with asset managers just to make sure that we better understand their process. and their views on climate risk, right? And I'd be curious, for example, if Ibrahim has kind of done the same in his own due diligence practices. But I would say, yeah, collaborative engagement and then due diligence is really where we're seeing some of those changes.
I think what I do, what I add to that, well, one, like as Marquette independent advisor, we don't take firm positions on systemic climate risks because we advise multiple shades of different kinds of states, red, blue, purple, and so on. So don't take a firm position. But at least when it comes, I really want to echo what Karin said, is that I think what I've seen on the universal owner side, it really comes down to, I think, engaging managers and ensuring that like all of them in some way have an opinion on climate change. I think the truth is that like with climate change, this is the greatest like arbitrage and market inefficiency problem there is. Like no one manager can say, oh, like a category 3, a category 4, or category 5 hurricane is going to have this effect on Florida's bond prices, right? Like there is such a wide dispersion on how people are thinking about climate change, right? But I think when you look at like the universe of managers, you have one side where some managers have not even started thinking about like stranded assets, internal carbon prices, energy transition at all in their analysis. All they're doing is looking at a balance sheet. And then you have other managers who are trying to, on the other side, creating like net, decarbonization glide paths for all the gig sectors and using that to inform a macro view and the fundamental bottom-up view, right? And so I think for us as both allocators and advisors, it's really important to like figure out like, well, on the spectrum of like how people are thinking about climate change, knowing that climate change is happening, no one has figured out how to solve for it yet. That's the billion-dollar question. Let's pick the managers who are at least in building the resources and thinking about climate risks across their entire investment process. And the ones who are further behind, both communicate to them, hey, we don't like your process. Here's why. Fire them if we think their process is deficient, which is within our mandate, if our clients have specified in their IPS that climate risk matters. But also at the same time, if we don't like what they're doing, say to them, hey, you're here, this manager over here who's within your asset class, who is your peer, who we are comparing you to, is doing that work, right? And so I think there's a way that like we can try to raise the standards of the industry by doing the manager engagement and pointing out how the laggards on manager work on climate risk can move towards being on the leader side.
Yeah, thank you. Those were really interesting and insightful comments. And just want to highlight like 2 things I heard is the value of these collaborative engagements, including CA 100 plus. And in that context, the departure of a lot of major US asset managers from CA 100 plus really raises some questions and some alarm. And then also wanted to point to Ibrahim's one thing that you talked about, Ibrahim, that is really resonating with me is like the really fundamental role that investment consultants play in this space in being the intermediary between asset owners and asset managers. I do want to, we have one question for Bianca. Bianca, could you talk a little bit about the hurdles that workers face in trying to communicate their issues to investors as a worker organization that's trying to activate workers in the investor space?
Sure, thank you. We try very hard as an organization to, provide a platform for associates, our members, to directly engage with investors, but we're a very small organization and, Walmart employs over 1 million people. And so it's just the sheer scale of the workforce. I think it makes it very difficult because what I have found in my time organizing and working with Walmart associates that there's just huge discrepancies when you go to stores across the country. We're talking about thousands of stores, middle managers are not necessarily implementing corporate policies evenly. And frontline workers do have a really interesting perspective to share. Anytime I do put a worker in front of an investor, they usually learn something, how a policy is actually getting implemented on the ground. And I don't mean intentional deception. I don't think that Walmart C-suite executives are intentionally trying to dupe investors, but I do think that there is a disconnect between what's happening in Bentonville, Arkansas, and what's happening on the ground in thousands of stores. And so that is a perspective that workers can provide, but it's very difficult to get in the room. And so the investor spaces like that get created by Majority Action or other organizations that we're a part of, like the Interfaith Center on Corporate Responsibility really provide a platform that allows us to bridge that gap. And so I'd say, more spaces like that are helpful. More organizations attempting to actually directly engage with investors, because there are other worker organizations in the country that I don't think even realize that these spaces exist. And so really, figuring out ways to open doors. And so I think those steps are starting. And to Divya's point at the beginning, I think those partnerships are the path toward hopefully starting to increase votes on ESG issues.
I can jump in here too. At the Treasurer's Office, and from my perspective, we have had quite a few meetings with union representatives on companies that we are engaging, especially in the utility sector. And those conversations have always been really helpful. And they've also, in a couple of cases, really shown us the difference between a couple of companies. So on one company, we might be getting a lot of positive feedback from unions, and union members are telling us that their negotiations are going well, that union members are really well respected. And then in the other case, we're getting a lot of negative reports from union members. So I think it can be really useful. And that's not really something that we would have been able to discern by just talking to the company or looking on their website, looking at news. Before meeting with unions, I kind of wasn't sure how their just transition, for example, was going. And I think just by talking with union representatives, we really saw a difference between these specific two companies that we're kind of looking at. So I would definitely encourage other investors to do the same.
Thanks, Karen. We have a bunch of questions on the chat. I'm going to try to get to all of them. The next question is, as you look to the next proxy season, are there any new engagement topics or asks that you feel may gain more attention from investors, or that may be particularly relevant to consider right now? So that could be related to climate or to diversity, or Bianca, if you want to talk about things that are kind of on your radar in terms of like the company engagements that you're doing. Does anyone want to weigh in here?
I can offer one. This is both. This is more like my view on this, and that I think is starting to become an emerging issue. I don't expect this to go to shareholder views, to shareholder proposals, but I expect this to like continue to become more of an engagement topic. I think as the energy transition really becomes a front and center, and US-China tensions escalate as we think about geopolitical risks, I am starting to see, but also I'm starting to expect managers to start thinking more about slave labor in the solar supply chain, especially with all these clean energy impact funds coming online, these global climate funds coming online, all these asset managers trying to win the climate dollars from allocators like the state of Illinois and other foundations who we advise, right? All these climate funds are coming on, and so much of the solar supply chain is just filled with slave labor used by Uyghur Muslims from the Xinjiang region. There are a handful of asset managers who are engaging on this topic, and I'm starting to see, but also hoping to expect that as we're thinking about these questions about like just transition and climate, that'll keep that question will become, I think, more important for investors to consider.
I can jump in too with a couple of thoughts from me. We're still in the planning process, obviously, for next proxy season, but workers' rights are going to be a big focus for us. And then we will also be going back to some traditional governance topics, and CEO pay is a big topic that we're looking at too. I would say on the human capital workers' rights side, especially with the SEC not mandating disclosure at this point, and any more than sort of a principles-based disclosure that we have right now, I think we'll pay more attention to the Human Capital Management Coalition 4 metrics that they have put forward. We continue to look at board diversity as a big topic. And then something that's kind of come up in this past proxy season that I think we'll continue to focus on is health and safety, especially when it comes to subcontracted employees, and kind of the strategy that companies are taking when it comes to subcontracted and part-time employees. So where does the responsibility lie? Does it lie on the main company that's hiring these contractors, or does it lie on the contractor side? And what happens when the company is publicly listed but the contractor is not? So that's an issue that we will be looking at, responsible contractor policies is something we engaged on last proxy season. I expect that will continue to be a focus for us.
Yeah, and then for us, Divya, I'd say, obviously racial justice and workplace safety are going to remain critical issues to both Walmart and Amazon workers that we are in community with. And I'd say, we haven't made any decisions in terms of refiling because all of that is done in conversation with our membership. But one question that has surfaced already is whether or not we wanted to sort of take another attempt to engage investors around an advisory board made up of hourly associates who could really help guide the board of directors on a number of issues. We had filed that a few years ago, and so it's something that we're trying to see if is there a different path? And so, more on that to come.
Great, thank you. Yeah, and I just want to share, something that popped up in the chat or in the Q&A. I am so inspired by the example of Walmart workers being involved in the process. Thanks for sharing. This was our first proxy season asking casino operators for a report on the business benefits of transitioning to a smoke-free policy, especially given the health impacts on large, very diverse workforces. And we do have casino workers involved, which, like you mentioned, Bianca, has helped bring forward a different perspective to asset managers to highlight the reality of real operational risks of indoor smoking. So just another example of the benefit of involving different types of stakeholders, particularly workers in these spaces, investor spaces. We have a couple minutes left before we close out. I had a question for Ibrahim. I'm wondering if you could talk a little bit about how clients can effectively engage their consultants, especially around proxy voting and proxy voting of asset managers. So what would you recommend in the next couple of months that clients do in terms of like investment consult? We often talk about activating their asset managers, but what does it mean to leverage investment consultants as part of that process?
Yeah, and one thing I'll say is why. I'll first say why we need to do this, right? Like, you might have a foundation whose assets are only like 30 million, 40 million, 50 million. It tends to be like the smaller asset owners who don't have professional staff who are hiring investment consultants. That's why we exist, And so there's so many different asset owners whose values are really aligned to these problems, but they outsource all their responsibility and manager selection and conversations to a consulting firm like my own. And in my mind, I think that's a real opportunity lost, right? When as a consulting firm, even though we're aggregating these assets, we're behemoths. Marquette represents $400 billion, right? And so when we take a meeting with name any asset manager, they're not looking at us as, oh, you're one asset owner. They're looking at you as a collective $400 billion entity. And so I think it's really important that as an asset owner, you recognize that when you are entrusting us with your assets, you're also entrusting us to speak on your voice on your behalf, right? And so I think it's really important that as an asset owner, ask us the questions and hold our feet to the fire when we do meetings with you and ask us, hey, what is your opinion on this year's proxy voting season? I read about the Walmart view. Hey, consulting firm, do you have an opinion? Have you asked my underlying asset managers who I'm invested with about this? It really starts with those questions, right? Like, asset owners should ask us, what do we think about proxy voting? They should ask us if we're invested in private equity, if we're ensuring that those private equity funds aren't screwing over workers when it comes to like childcare and, hospice care and so on, right? And you shouldn't do it in just one meeting amongst several trustees because there's so many different like interpersonal and political dynamics that can, I think, diminish your voice. Have an active conversation with us outside the regular meetings, talk to us, and really try to like ensure that if you ask us a question once, keep following up on it, because that'll force us as a consulting firm to get better. Because I'll tell you this, having worked at several consulting firms, spoken to my peers as an industry, we're very like slow and passive, right? We will only do things if our clients ask us to, right? And if multiple clients ask us to, and many consulting firms are not thinking about proxy voting and engagement, right? We're kind of shying away from this question, right? But as I said earlier, it is within our fiduciary duty for quality control. It helps us do better client service, and it makes good business sense for us, right? We might just need our clients to, I think, just keep prodding us to do this. So specific asks, ask us questions about it outside of regular meetings. Ask us to benchmark and evaluate your underlying managers. When you're doing searches for new mandates, specifically ask an ESG analyst ask the consultant to speak to not just the risk return profile and vehicle availability, but ask them to speak about like proxy voting and use proxy voting as part of like a tiebreaker or one of the factors when you're selecting your managers. Add some language in your investment policy statement that says, all things considered, when we're selecting managers, not only will we look at ESG, but we'll also want to assess the proxy voting of our underlying managers. And then I think the final one that I'll say is that when you are going out to RFP to select new consultants or even to rebid your existing consultant, you should add in your RFP process questions on what are your, on how is the consulting firm thinking about proxy voting. Because whether or not like we win that account or another consulting firm wins that account, by saying to the market that you are expecting consulting firms to think about proxy voting, that's going to force us to like really upgrade our process. And then it's going to force us to start actually engaging with the asset managers. All this work that I did for the last 2 years on proxy voting, it only happened because 2 years ago, our clients started asking, and that gave me the market demand signal for me as like the internal change agent to like build this whole proxy voting platform. So if allocators aren't asking, we're not going to do it. So please ask. I kind of want to have some more fun.
Good intel. That's great. Thank you. This is going to be our last question. As I noted kind of at the beginning of my presentation, the risks of climate, racial inequity, income inequality are intensifying. Is that, I know there's a lot of competing demands on our attention right now, especially in an election year. And so I'm wondering, though, if this is translating, the risks of climate and racial inequity are translating into new urgency from your stakeholders. Are you seeing a kind of growing recognition of the risks posed by these risks, by the growing recognition of the risks posed by these issues, given kind of all the headwinds? Ibrahim, have you like kind of encountered this, or do you have more and more folks coming to you to ask about, systemic climate and racial inequality?
My connection tuned out for a second, so I was hoping you wouldn't call on me. Could you repeat the question?
Yeah. I mean, I think the final question is just around sort of urgency. We are seeing like intensifying urgency around, we're seeing that the risks of climate and racial inequality are intensifying. And so I'm just wondering if you are noting that in your kind of conversations with asset managers and asset owners. Is there a growing recognition that the crisis is intensifying and that we need to do something about it? Or are you seeing a kind of like lulling kind of effect right now?
Yeah, so what I'd say is that like because I spend all my time with asset managers all the time, I feel like the standards of expectations that asset managers are setting for companies when it comes to like managing climate risks and like the sophistication that managers are setting in their investment policies is increasing from like what I saw like a year ago or even 2 years ago. And so like from the asset manager side, like that dispersion on like asset manager who has no opinion on ESG and is just recycling MSCI data versus those who are thinking about like deep decarbonization in each gig sector, I feel like that dispersion is widening, right? And there's more people moving towards like up that sophistication curve. So like I feel like on the asset manager side, like there is this like increasing sophistication and how you're thinking about climate risk. Does that translate to real world climate impact? Who knows? Climate change is like you have to fire on all cylinders problem, right? So I do feel like you're seeing that like sophistication increase, and I feel like I've done more searches in the last like 9 months that have been more climate orientated, and I met with more trustees who are asking for more climate solutions or like climate smart investments, right? So like this from like my specific purview, like I feel like more is happening, but the climate problem is so large that any meaningful progress just feels so insignificant. So, but at least from my side, I feel like there's more going on.
Lauren or Bianca, do you want to have the last word, either on this question or anything else?
I guess I'll just say, personally, for our constituents, our beneficiaries, we don't have, or I personally don't have a direct channel to talking with them, but I personally feel the urgency. it's hard to not to feel it. You know, we are seeing the impacts of climate change every day. There's policy change happening at a large scale, and I think it's hard to ignore. So for me, I'm feeling the urgency personally, and I'm, you know, working my hardest to move us forward. But maybe I also share some of Ibrahim's sentiment in that it feels hard to see progress and impact, and just hoping that everyone joins us and does more.
And I'll just add, Debbie, before we go, that I do think that the members that we work with are starting to really, I mean, they live in communities that are disproportionately impacted by a lot of these harms. And so, we have been in conversations with partners around how do we join forces? Because the intersection of climate justice and worker justice, I think, is sort of the next frontier for us.
It's really exciting. All right. Well, thank you so much to our panelists for a really fantastic discussion. I'm going to move us to closing. Laura's just going to pull up our slide deck again. Great. So I just want to note some next steps that you can take as active owners and as active clients in the next couple months. We encourage you during this time to assess and strengthen your own proxy voting policies if you have them. We encourage you to assess the alignment between your stewardship objectives and your asset managers, your investment consultants, your proxy advisors. This is a good time to reevaluate these relationships. You will be receiving majority actions analysis of the 2024 proxy season in your inbox in a few weeks. We encourage you to use that as a tool to engage your asset managers and to discuss their 2024 proxy voting records. And finally, Majority Action is going to be hosting an active client workshop on Thursday, August 15th at 11 a.m. So we will send out a registration link soon, but please mark your calendars for that. All right. Thank you so much for joining us on a Friday. I hope you all have a wonderful weekend, and definitely get in contact with us if there's anything you would like to discuss. Thanks so much, everybody. And thank you to our panelists.
Thanks, everyone.
Thank you.